talk about roles and responsibilities of each party involved in the risk assessment process. And we'll do it from the vantage point of a large company so that you can scale it down to the size of your own company. Then we'll talk about the methodology for a successful risk assessment process, just from my own best practice and experience. And then we'll go through some examples of templates, just some real simple Word documents and maybe some Excel spreadsheets, but there are good examples of what you can use in your own process and maybe just compare and contrast to what you're already using. And then we'll go on to continual refinement of audit projects throughout the audit year, because as we all know, hopefully, if you are an internal auditor, that the audit plan is going to change. Undoubtedly, it will change, which is good and normal. And then we'll go through just a very small example from start to finish of how this process can work within your organization. So don't worry, I know we started at maybe, well, let's just get started. Okay, so the key elements, we've identified the key activities that we believe will guide and the internal auditor or whomever is performing really the risk assessment within your organization to help organize the process and present some form of organization. So, for example, it makes more sense to me to interview directors and lower-level personnel prior to meeting with the VPs, because your vice presidents will likely have the final say on projects and will also likely need input from their leaders in the specific areas. So I highly recommend scheduling meetings with all your parties involved well before the time frame when the annual risk assessment will occur. So I know when I was involved, we scheduled meetings beginning in July in preparation for an annual meeting in September to come up with the next year's audit plan. So again, the corporate-wide risk assessment should be considered a fluid document. Things will always change throughout the year. So there needs to be some flexibility built into it, which we'll discuss throughout the presentation. But for now, begin to think about managing your projects that you consider above the line and below the line. So in other words, you're going to start with an ample list of projects that you can choose from. Okay, so this is just a screen print of the risk assessment template. And I know you can't see it very well, but don't worry because we're going to go through it in detail. Because this is really the template that you will use quite a bit for a corporate-wide risk assessment. And I would use this as a starting point and then modify it as you may see fit for your own organization. I'm going to explain each column from left to right, and I'll try to explain each one in detail, but I'll let some of them go as I think they're pretty self-explanatory. That being said, if you have any questions as I go through that and I don't explain it, please ask. So, okay, so the first column is simply the number, which may seem like a really easy thing, but you'll want to number your audits throughout the year. And I warn you that because assuming several different auditors will be participating in this process, you should have some sort of an administrative person or someone who's good at Excel that can consolidate all of those to get audit numbers consistent and in order. So when all is said and done, you can have a audit program with one audit number per audit. So the second column represents the internal audit manager. So note here that the way our organization was set up hierarchically was the chief audit executive, which reported to the CEO and had a dotted line to the audit committee. Now the chief audit executive had 3 managers that reported to him, and the managers each had 2 to 3 audit consultants, and then there were audit seniors and auditors that reported up through the managers as well. So the audit consultants, which I was one at one point or another in my career, we were responsible for performing the annual risk assessment. So the audit manager column is just a way to see which manager was responsible really for which audit. And as a side note, and maybe obvious to you, but each manager was then responsible for certain business areas within the company, which leads us to WOW, just our third column here, but which is business area. Okay, so to move us on along a little bit, let's talk about the next column, which is sub-business area. In this, for example, we had procurement, which was under the supply chain functions. And for example, under supply chain functions, we had purchasing and accounts payable, and they fell under as a sub-business area. So that's what we mean when we talk about sub-business area. And the next column is function, an additional way to break down the company into its smaller functional components. You may or may not need that category, depending, again, on the size of your company. Then the next column is executive. And that's the vice president responsible for the area that you're going in to do an audit. That's followed by a column that has a sponsor, their sponsor's name in it, and the sponsor is usually the vice president of the area. But the sponsor is responsible for ensuring that any audit findings are remediated when the project is complete. And they're also responsible for seeing through the successful completion of the audit project. Then the next column is client. And this is the director of the area being audited. The following column is primary COSO risk category. And if you are not familiar with COSO, it's the Committee of Sponsoring Organizations of the Treadway Commission. And that was started as a joint initiative of 5 private sector organizations, which were established in the U.S. and dedicated to providing thought leadership to executive management and governance entities on critical aspects of organizational governance, business ethics, internal control, enterprise risk management, fraud, and financial reporting. So I usually skip over that, but I think some people might forget what COSO is when we use that term so loosely, so it's kind of fun to have it defined. But the categories that they're broken down into in this particular column are the 3 main categories of COSO, which are compliance, operations, and operations financial. Then the next column is primary risk, and this is broken out into what our organization considered 11, as I filtered it, we had 11 different primary risks, and they are as follows. Hopefully you have some that are similar. The first one is business interruption and continuity risk. The second one is capacity risk. Then we have contract administration risk, financial management risk, information integrity risk, performance gap risk, regulatory credibility risk, regulatory requirements risk, reporting risk, safety risk, and finally tax risk. So those aren't all of our risks, but those were, as I filtered it, the primary risks that we had within our organization. And I should back up to tell you that I worked for a very large utility in town, so we had billions of dollars in revenue, which is why we had so many auditors. We had 25 auditors in our group at the time. Then we had a column for CRO risk, which was the Chief Risk Officer. And this was Internal Audit's way of linking our corporate-wide risk assessment to the Chief Risk Officer's risk assessment at the time, which I'm told is a little different. Or it is a little different. It's pretty high level in terms of risk. And then we got down into the nitty-gritty in the Internal Audit Department, but their main categories were just 2, and they were environmental and operating risks / business continuity. So it was pretty easy for us to categorize our risks and link it to theirs. Then the next column is other risks, which is broken down into fraud risk, performance gap risk, and fraud, and then regulatory credibility risk. And again, that's when I filtered the other risks. But obviously you and I actually have a lot of other risks when I do my own risk assessment within the current organization that I'm in. You can have more than one risk. I think it's just good to focus on having a primary risk, and then the other risks can be categorized accordingly. Then the next column is audit topic. and this is just simply the name of your individual projects that you come up with. And that's followed by a column called engagement, and this can be broken down how you have your projects organized, and I'm guessing you have them organized the same way we did, because we just categorize them into an audit or a consulting project. The next column is target hours, and that's simply the number of hours the project is expected to take. And then that's followed by a column for cumulative target hours, and that's just accumulating the number of hours of all the audit projects on the risk assessment. And hopefully that's obvious to you that it's just to keep track of how many resources hours we have in terms of the number of audits we're adding to the plan. Then the next column is the overview of the proposed audit, and that's a small description of what the audit project entails. Then that's going to be followed by audit timing, and that can be broken out however you decide as well. We did it by quarter. And then the next column is operating companies. So for large organizations, you may have several operating companies that roll up into the corporation, and sometimes projects affected all or one of these companies. So this is an area where you can categorize them out and click, check if it applies to a specific company or not. And that's going to be followed by a column called impact. And this is the first subjective category whereby the projects get categorized. So it represents the impact this project will have on the organization. It could be either a 3 or a 4 in our organization, and I'll go into how we score them later. But the next column is likelihood, and that's the next subjective or objective category, and it simply represents the likelihood that the risks identified may occur. This is also categorized as either a 3 or a 4 in my organization. And then the next column is a category called multiplier, and that was the third and final subjective category that was utilized to either boost the total score on the project or reduce it. And this could be broken down into between a 1 and 1.5 in increments of 1.2, 1.25, or 1.5. But these three categories, likelihood, impact, and multiplier, are then calculated, multiplied together, one times the other, and that would give you the total score, which is the next column for the project. And the higher the amount, obviously, the better chance the project has of becoming part of the audit plan. And it's also where we determine whether the project was considered above the line or below the line, which I'll explain in an upcoming slide. Then the next column is the general comments column, and this is where you can make notes regarding maybe how a director or a VP reacted to a specific audit topic that you brought up. The next 6 categories are strategic planning, regulatory, operations, legal, IT, and financial. And those can all be numbered with a subjective number to indicate how likely the project would impact each of those areas. And I have a slide coming up that will get into detail about that too. It's kind of the science behind how we come up with the numbering system that we give to each project. Then the next column is a likelihood comment, and this would simply reflect any notes having to do with the likelihood of a risk occurring without performing the audit project in any given specific area. Then the following column is who requested it, and that is simply who in the organization suggested the audit. And that's followed by a column for general impact comments, and it's simply another area where notes on the impacts of the audit projects can be recorded. Okay, so that's the end of the detailed risk assessment template columns. And that is close to 40 different columns of data. But I will tell you that it really does come in handy to have all of this in one place, because obviously you can scale it down if you want to and hide columns if you don't need them. But it's really great to get all of this down at one time, once a year, for your corporate-wide risk assessment. So let's about above the line and below the line. If any of you are accountants, which I'm sure a lot of you are, or started out that way, it should make sense to you. But this is the negotiation process, really, whereby all the audit projects go through. And it's subjective, and it requires objectivity from the auditor and the department leaders to decide whether or not the project gets on the audit plan. And that's what we refer to as above-the-line projects. Or if it doesn't, which were the projects that we refer to as below the line. So you can formulate this any way you want for your company. We did it based on the above rating and would rank impact and likelihood anywhere from a 2 to a 5, with a 3 and a 4 usually being utilized most of the time. And then the multiplier would be the ultimate subjectivity of the auditors. And again, it's important to have one individual that has control of how these things are being ranked and the final score of the audits that end up above and below the line. Because I'll tell you, it becomes kind of a mess when we have our department-wide meeting with 25 different auditors, or I'm guessing it was probably 15 people in the room trying to decide which projects made the audit plan, which were above the line, and then which would fall below the line. So let's talk about some fun stuff, or more fun stuff here. I find the easiest way to manage the overwhelming topic of the corporate-wide risk assessment is to break it down. So really, just like any other major project in any area of your life, you know, projects must be broken down into tasks. So to project this on to your organization, I would simply start by breaking down vice presidents by business area, and then take that business area and break it down by director. And from there, you should be able to come up with a multitude of areas where projects can be initiated. These can be areas where internal audit can provide value by discussing with management their individual goals, key performance indicators, and where we might be of assistance to them and to achieve those goals. So for me, if I'm working in a company that manufactures something, for example, the first area I'm going to think of is inventory. And this is highly likely where a majority of the company's capital is invested. Unless, of course, say they're building a new facility, then I know that capital will be tied up in construction contracts and new equipment. And this is where I would focus my efforts. So if you really just think about where your organization is in terms of goals, this process should quite easily unfold in your mind, at least, to begin with. And it can be fun. So please do try and have some fun and use your creativity with this process. Then I try to think of other areas in my company that may spend a significant amount of money, which currently makes me think of attorneys. So if your company is outsourcing attorney fees, please consider performing an audit of attorney's fees and how this process is being managed. Any other third-party contracts are always tremendous sources of audit projects. So again, follow the dollars in your company. It's quite easy to perform an audit of terms and conditions of any contract your company has negotiated. So depending on your industry, for example, in the power industry where I came from, we did audits of purchase power. We made sure that our purchasing was in accordance with the contract. And how we did that was we reviewed invoices to ensure the pricing matched the term sheets. Now that may seem like a real easy process to you, but to me, it was very difficult, mainly because these contracts were written by a mathematician. So, got into a lot of engineering and the heat rate of different power plants and how the electricity was being generated and if it was being done efficiently. And all those things were combined into this contract. So, trying to come up with the correct pieces to calculate the invoices was not an easy process. That being said, how I described it was the easy way of ensuring that a third-party contract can be reviewed. Another major area of concern to companies in any industry are major projects being performed. So if your company is in the process of building a new plant or implementing a new computer system. These are really areas where internal audit should be involved from the ground floor. And another area is assisting in developing policies and procedures. This should definitely be done in conjunction with management, of course. And I say this now because I'm doing it, but never agree to write policies and procedures for management. Now, mind you, I work for a smaller company now, so we don't have as many resources, so I am writing policies and procedures, but management really owns this process, so regardless, I have to make sure that my managers understand that they are the owners of that process, but I will guide them in writing policy and procedure. It's important to have that structure, and it's also probably a project that you could put on your list if you don't have policies and procedures, because what are you going to audit to? You got to have policies and procedures to make sure that your company is in compliance in a lot of these areas. Additionally, you can think about your company's SOX cycles if you have Sarbanes-Oxley going on. These are great sources of audit projects. And all you have to do is really simply evaluate how these processes performed in the prior years, and I bet you could come up with a multitude of projects to perform from areas that didn't meet or beat expectations. So again, from my experience as an auditor, this is going to be a little repetitive, but hopefully it'll sink in then. Some of the largest and best audits that internal audit can provide good value is in regards to any new system implementation and or upgrades. It's usually a good thing to be involved in from a practical and a political standpoint to ensure the best possible implementation. Then this usually involves an auditor with some system experience, but it doesn't need to. Just making sure that policy is being followed if there is one, and if not, then making sure that the management knows they need to come up with policies and procedures. Anyway, obviously very dependent on where your organization lies within the timing of system implementation and upgrade scheduling. Another great area to start your corporate-wide risk assessment is to circle back on the previous audit year. In my experience, there's never enough time to hit the number of projects identified as being required or a good idea. And many times, I'm sure you've all come across this as well, while scoping an audit, it must be cut back, sometimes extremely due to the amount of time that you have to dedicate to one project. So our department used to have auditors keep track of this, and it was also a good source of additional audit projects if we needed them. So from my experience, most audit departments just don't ever have enough time, which is good. It's job security, right? It's really fun, though, to be a part of the annual risk assessment process, especially when you have a team of seasoned auditors that know the organization and the different business areas and their respective management. It's always amazing to me to see what a great final product we came up with when everyone put their respective efforts in, and also respected each other in terms of, you know, stepping aside when we knew maybe there was more risk in IT, for example, versus the project that we're pushing in operations. Additionally, it's always a red flag when management doesn't consider a project recommended by internal audit. So my recommendation is to please vet these projects out with care. Some may need to be forced upon management in a politically correct way. Others not so much, but again, be wary of the battles that are chosen. I've had many colleagues tell me that if they didn't make someone angry through this process, then they weren't effectively doing their jobs. Now, while I don't recommend going around making everyone angry, because you still have to work with them, it's worth thinking about through this process. You don't want to be the yes auditor, if you will. You want to challenge management and make their organizations better. Major contracts, especially ones that tie up large sums of money for your organization, are always, always a good place to spend audit hours. I've done many of these, and I've saved companies that I've done them for a lot of money and time. They usually end up in contract renegotiations and many times reimbursements to the company for misrepresentation of contract terms. Another area is anti-fraud audits. Let me back up. So, for example, the purchase power audit that I performed for my company, I did find an error, and the only reason I found an error was because I was at the vendor, at the other utility for 2 weeks going through documentation. And I just so happened to make a phone call to the engineering department and spoke to someone who sent me a report of what the actual heat rate was for the power plant in question where we purchased power. And lo and behold, that rate was different than what was on the invoices. So they were overcharging us on our invoices. And that resulted in close to $1 million worth of invoice credits and renegotiations with that company. So that's just one example. That's probably my biggest example of saving a large amount of dollars for my organization by doing a vendor audit. So again, I'll move on. Anti-fraud audits, they're also a good source of internal audit projects. And so if you have a CFE, a Certified Fraud Examiner on staff, it's good to do those types of audits as well. There are many areas in the organization where these types of audits can uncover issues or ensure management that they appear to not exist. And I'll give you an example of what that is because you might not know. And accounts payable is always a good source of projects that can result in bottom line results from reimbursements for duplicate payments, for example. So it's really data mining, going through large volumes of data and looking for places where we paid vendors twice. It's a good area to address within your organization and an area where you can actually come up with dollar values that you save the company. So lastly on this slide I have a bullet point called organizationally determined. And what that means is that the projects will definitely depend on your specific organization and management styles and how much authority internal audit has within the organization. So hopefully you have the authority to look at whatever you choose, but different companies have different levels of respect for their internal audit departments, so that will vary depending on the company, right? Okay, so let's move into the roles and responsibilities of people within your organization. Again, I think it's really good to have this stuff documented so that you can send this out and or explain to management how this should work and how it should work efficiently and effectively. So executive management is responsible for ensuring that the appropriate organizational and policy components are in place to ensure that the risk assessment is performed and appropriate action is taken when findings are identified. So organizational components include a corporate compliance group and an independent internal audit function reporting directly to the CEO. So the policy components include the company formal policies and procedures to define compliance and an audit process to address noncompliance. Then the directors within the organization, with the support of executive management, directors are responsible for maintaining and communicating the company's policies and procedures as well as facilitating the enforcement of the remediation process when findings are identified. Then your process and control owners, the business process managers are the primary owners of their processes and procedures and instances of compliance and non-compliance with them. So they're responsible for maintenance of those controls, monitoring of control changes, self-assessing control effectiveness, and remediation of control deficiencies should they occur. They are also responsible for the identification and documentation of their process narratives. So if that sounded very Sarbanes-Oxley, it was. And I imagine if you have Sarbanes-Oxley in your company that you would define that as such, because there was definitely an educational process that had to happen in organizations to implement Sarbanes-Oxley, and that was to identify what controls are and ensure that management understood that. So I'm sure you're all familiar with that if you've been involved in that process. Okay, Okay, so SOX Management Office, of which we had, because again, we were a large organization, so our SOX Management Office had the primary responsibility for managing the risk assessment as it related to SOX controls. So that group documented the management program and coordinated appropriate communication of those results. They also assisted in documenting existing anti-fraud controls, and they performed the rating of the inherent and residual risks in that process. So the SOX Management Office gathered appropriate feedback and information for management, internal audit, and the external auditors to ensure a complete and thorough assessment was completed as it related to SOX controls. And organizationally, that group resided in the controller's area, so they were in Park County. An internal audit, we were responsible for conducting the company's corporate-wide risk assessment, which we're talking about today. The program included performing audits, conducting investigations, and coordinating applicable training. Our primary role in the risk assessment process was to identify potential audits for our company and industry and to provide input on the risk ratings. We also performed an internal independent check on the effectiveness of the company's control. So we resided in the CFO organization, and we had independent sessions with the audit committee, which provided increased independence. Now, when I first started with this company, we reported to the CEO, which I highly recommend. But I think a lot of internal audit groups are now reporting to the CFO, which is, to me, sort of a conflict of interest. But in my current organization, I am the CFO, and I am the internal audit department, so that could be a conflict of interest, too. I don't know. In any case, the external auditors were also part of this process, and they should provide internal audit feedback on the quality of the risk assessment process. So those are all the parties involved in that process and what their roles are. So when I read the title of this slide, I first thought to myself, well, this could be the title of the entire presentation. So I'm going to interpret methodology as describing to you from my own personal experience how to kind of stay on top of this process as best as possible while still trying to semi-perform your regular job responsibilities. And I will tell you that it's not easy. And for those of you that have gone through it, you know that that's the truth. So for the most part, you're going to have to expect that your staff that are involved in this process are spending, I would say, 80 to 90% of their time on this process during the annual risk assessment. It's important to have and to maintain an open communication process with your staff during this time. The first priority is to set up a schedule of meetings. And as I previously mentioned, you're going to want to start from the end and work backwards. So if you know that your department-wide meeting where you discuss all the audit projects is going to be around the end of September, say, and we worked on the calendar year, so we started January 1. Then build in time to schedule BP meetings up until that department-wide meeting date. And then from there, schedule those meetings. And I put this in as a side note, but it's really not a side note. It's really important information. It's always wise to include your department admin assistants, if possible, in scheduling those meetings. I know personally we could not have done it without ours. And as you're probably aware, you know, they're probably the most important person to to be nice to anyway, because they do a lot for us. But they many times have a relationship with the VP admins. And together they can schedule meetings, because a lot of times they maintain their schedule anyway, right? So if you can get them talking, communicating, and getting you on their schedule, you can schedule those meetings much more efficiently. So I highly recommend utilizing those folks if you have them. And if not, it's a good area for improvement to get them involved. From there, I would schedule a meeting with all the directors of the company that report to the respective VPs. And don't leave anyone out. Also, if you know of managers that have political clout, it doesn't hurt to schedule meetings with them. In fact, I highly recommend it. Now, I'm going to skip to the next slide just to show you an example of the notes. This is a template of the notes from the meeting with the director and how this plays into putting together what we call the agenda for the VP, which I'll show you as well. But simply put, your meetings with the directors that report to that specific VP will have a requested audit project section, and that will be listed on the agenda to discuss with the VP. So it's always surprising to me, sometimes, the disconnects between directors and VPs. There were times when, I'm going to go back to this now, there were times when the VP would come up with an audit that the directors wouldn't have, which would surprise the VP and vice versa. So just be aware that sometimes the nice list you go into a meeting with a VP with doesn't come out the same way. It might look a little messier. But my suggestion on coordination of the meeting notes into your risk assessment template is this. So I always had my own risk assessment template, as did all the different audit consultants, that I filled in with the suggested audit projects as soon as my meeting day ended. This way I had everything ready and could always delete topics, but I had them all in one place to have an appropriate audit trail for my work performed. And so I would have fresh memory of what actually occurred in that meeting and what I needed to get down on paper. Then after I did that, I would also do my preliminary subjective rating of the impact and likelihood. Now, keep in mind it was never final, but it was just nice to have something in there to begin with. I could always go back and change it, and it did get changed from time to time, but it's always just good to have that first impression in there. Then our department-wide meeting that occurred every September, and this was subsequent to all the management meetings, this would come after a meeting with my own manager. So in my meeting with my manager, I came to the table with all my projects described and the ratings set. So then in this meeting, I would present each project to my manager as if I were presenting in front of the whole department. So it's kind of a dress rehearsal, really. And also the reason being is because my manager and I would edit the risk assessment template based on our discussions, and this is where we would establish which projects we wanted to make the list. So sometimes, you know, my manager had different knowledge than I did in different areas, and maybe had met with the other managers and felt like he knew what the risk was to the organization based on those meetings. So then after that, the meeting with the entire department was basically a huge negotiation session. Meaning we would have to fight for the projects we wanted to make the list. Because as you all know, there are only so many hours and only so many projects which would make the above-the-line demarcation. And these are the projects that would ultimately become the audit plan. So the projects that then fell below the line weren't off the table entirely. It simply meant that they would be deferred until further notice, if you will. So if we had a project canceled or something moved, etc., we would pull from those projects and add them to the audit plan. So my recommendation here is to not get attached to the final product of your risk assessment in your audit plan, because it will inevitably change. But it is amazing how many projects do ultimately get done, and I think I've heard from a lot of my colleagues in my own department that auditors tend to get stuck on a number. So once the audit plan is finished, they have that number of audit projects that need to get completed, and that can kind of screw things up, or it can challenge you to achieve that amount of projects during the year. Place for debate, but we don't have time for that today. So again, here's the template for notes. So it's an example of a meeting minutes from a director meeting. Just note here that prior to going into these meetings, it's a good idea to utilize your knowledge of the area and brainstorm the different types of risks that may affect the business area. Our department maintained what we call the risk universe with definitions. And the main categories of that were compliance. So as an example, contract administration risk, or failure to administer the contract properly, which may result in lower quality, higher production costs, lost revenues, fines, etc. is an example of a risk and its definition. Then for operations financial, we have an example of that type of risk as budget and planning risk, and that is defined as non-existent, untimely, unrealistic, irrelevant, or unreliable budget and planning information may cause inappropriate financial conclusions, decisions, and outcomes. Then another category is operations human resources, and an example here is competency risk, which is defined as a lack of requisite knowledge, skills, and experience among the company's personnel, threatens the achievement of critical business objectives, and maintaining an acceptable level of business risk. Then the next category is operations, and an example of that is business interruption and continuity risk. And that definition is inability to sustain critical operations, deliver products and services, or unavailability of critical resources as a result of interruptions from accidents, weather, strikes, sabotage, terrorism, or acts of war. Then the next risk category is reporting, and an example of a risk here is information relevance risk, and that is defined as irrelevant information which is created or summarized by an application system, or the creation of irrelevant or redundant application systems may adversely affect decisions or are not aligned with operating objectives. And then strategic is our final category of risk, and then an example of that is capital resource allocation risk, and that's defined as an inadequate capital resource allocation process, and the information supporting it may preclude the company from establishing and sustaining competitive advantage or maximizing shareholder returns. So those are some examples of risks that you can bring into these meetings to explain to the different managers and directors that you believe that this risk exists within their organization. Now here's another template, and this is an example of a VP agenda. So this is for the meeting with your VP, and it's set up so that you can really educate the VPs on what internal audit provides to their organization. And I say her organization, just because I'm biased, and I would hope that there will be a lot more hers in organizations coming soon. But keep in mind, you probably have an hour or so to talk to the VP, so make good use of your time. As you can see from this example, which is simply a Word document, the Internal Audit Services Organization chart is included. Then the typical audit process, which includes the following. So you'll define what risk you start with the risk assessment and project scoping to establish your work objectives, and then you're going to perform field work and audit testing. After that, audit issues the draft and final report, and then that's followed up by follow-up on open management response items. So that's 4 bullet points to describe the audit process to the management. Then the VP agenda goes through to discuss really the annual audit planning process and cycle, which is as follows. For us, it was in September we had the risk discussions with management, and then by the end of September we had prioritization of the proposed projects for the next year. And then in the September and October time frame, we presented the next year's audit plan to management for additional discussion. Then in October, we would present the final plan to the CEO or the CFO, whoever you're reporting to, and then also present the final plan to the audit committee. Then your agenda is going to include kind of your audit risk assessment, which will include risk factors and possible impacts.
And then after that, you're going to have your current year audit plan status that you're going to present. So basically where you're at with your current year projects for a specific area that you're auditing. And you'll discuss this with the department VP, let them know what the status is. And then finally, you're going to have, what you suggest or recommend for your current year or the following year audit topics. And we just basically separated them out into two columns. The first column would be your risks, and then the second column would just contain the different audit topics or projects that you were proposing for that year. So again, this is just kind of your roadshow and educating your VPs on what internal audit does for them and what your proposed projects are for the upcoming year. So this slide is we're gonna move on to kind of the science behind, if you will, the entire template that we went over originally, or on the second slide of the presentation. But this just defines kind of the subjective categorization of where a project landed in terms of above the line and below the line. So this will differ for your organization depending on thresholds that you set, but you can see, for example, like a level 1, which was considered insignificant, and if we were in, for example, the regulatory area, you would see that we would categorize it as a level 1 because the risk posed a minor compliance issue if it was encountered by your organization. So that's kind of how you read this risk factors and possible impacts. And then how you take that to your risk assessment and, you know, put some numbers to kind of how you're categorizing the risk involved in that particular project, what you're trying to mitigate with that project. So it's kind of an interesting slide. It's worth taking some time and getting to know what that would feel like and look like for your own organization. But it's kind of a nice way to put some weight into different areas for your risk assessment. And this template is just, again, it's just another Word document that we used. We use these during the risk assessment because it's a template for a project initiation form that we would have taken while performing another audit and just coming across another area that possibly could use an audit of its own. We use it to track projects that came up through the year that might be candidates for the upcoming year's audit plan. So you can see it just sort of discuss what area it is, what the risk is. It's good that you have to define that up front, what risk you're proposing that you're going to mitigate by doing this particular project, and then the objective of the project, whether it's SOX related, what the scope is, what the background is, all that types of information. And then, you know, if you're a senior auditor, then that would be given to your manager to review and or ultimately say whether that was a good project for the upcoming audit risk assessment year. So we kind of talked about the different risk definitions, and this is just a screenshot of what our list looks like, and this is the compliance section. So these are all the risks that we have in terms of compliance. And this, you know, keeping an entire list of risks comes in very handy when you're putting together your corporate-wide risk assessment. If your company, you know, does what the community describes as a risk-based audit plan, which I'm pretty sure most companies do at this point, then you should definitely have a comprehensive list of risks that come out of the different COSO categories or whatever. However you want to maintain your list, you can maintain your list the way you want to. It's really your list. But it should be tied to every single project that is added to your audit plan. So, for example, your project is on the plan to help reduce a specific risk to the company. So you can honestly you could also start with the risks and determine whether your company has that risk within their organization and then develop a project from there. But more often than not, one of our go-to risks within our organization was the performance gap risk listed under operations. And that the definition of this specific risk, again, which is performance gap risk, is the inability to determine and improve appropriate gaps in corporate performance relative to stakeholder expectations and competitive position. So it was utilized a lot because you can tell based on the definition, it's just a gap in controls, basically. So it's a good idea to take a look at this list frequently when you're putting together your corporate-wide risk assessment. Risk, really should be identified if you're a risk-based audit shop. Even if you aren't, I would be surprised if you aren't, but it's always a good idea to have, a certain risk that you're trying to mitigate by doing your projects. So continual refinement of your audit plan throughout the year. Given the nature of projects and just life, things are going to change. We always had issues with timing. Just a heads up, and perhaps you're already aware of this, but it's good to come up with ideas for first quarter. Inevitably, process owners want ample time to prepare for an audit. People are coming off the holidays and or the end of the year. So first quarter was always hard to plan projects for. And your business area owners and sponsors are always trying to push projects into the second through the fourth quarter. So it's rare, but it does happen that someone will be ready to go in the first quarter. But and if they are, please take them up on that because that's kind of rare. In terms of scope, it's usually decided during the audit planning process. Therefore, always keep in mind that the scope may change from how the original project was described. And this is normal and to be expected. But make sure that you touch base with those individuals who requested and or discussed the original project and make sure that they're okay with scoping of the project. As an example, I had a project that was on the audit plan, which I was not involved with, that had a scope that the director didn't really agree with. He didn't feel it would add value, so in conjunction with management and the VP, we changed the scope of the audit to make it worthwhile for the director, and one that both he and the VP and internal audit management felt would add value to the entire organization. And that'll happen, so be open to it. The more refined you can make projects so that they do add value, the better off the organization as a whole will be. So, on the other hand, be aware of business managers or process owners that may try to get out of having the project completed at all. That also occurs. So make sure everyone is on the same page about canceled projects. That should be a big deal on occasion because the audit plan is essentially approved by the CEO and the audit committee. So while allowing it to be fluid, it's also important to keep its integrity so that internal audit doesn't misrepresent what it is achieving for the organization. And then inevitably, resources are going to be pulled throughout the year. I know in my own experience, I had to perform internal confidential investigations all the time, it seemed. And I had to fit them into my schedule alongside audit and consulting projects. Now, while it was doable, it still constrained me as a resource. So this may become an issue for your department and the goals of the audit projects on the corporate-wide risk assessment process that they may have to be delayed or pushed the following year because of that. And project scope changes may have been mentioned previously, but it should also be mentioned that project scopes can also be expanded during an audit depending on what the auditor finds once the project is initiated. So just be aware that this can also constrain your resources as well from achieving the goals of the department. So lots of moving parts and changing pieces that will cause the plan to change. So if you don't get attached to it, you're better off because it will change. So I'm just going to do a quick example so you can get an idea of how this process works from start to finish. So this is an example of a suggested audit. It's a new expense reporting system in AP, and it was suggested by the manager of accounts payable. And they wanted internal audit's input on the implementation process and ultimate documentation of the process processes and procedures. And then the process that this project went through during the corporate-wide audit plan process would be similar to this. So this would have come out of a meeting with the accounts payable manager responsible for implementing the system, which would have come out of the template for, if you recall, the template that contained our notes with the director. If we would have kept those notes similar and pulled this audit out of that. So the auditor would then identify what risk this audit would alleviate. In this case, it would be our old favorite, the performance gap risk. And the overview of the audit would be something like this. This audit will be to review the processes and controls in place to ensure accurate and complete expense reporting. The new system will replace the old system. The new system is anticipated to be implemented in March of 2019. And I'd give it a target hours of, say, 240. That was kind of a go-to number for us, for whatever reason. And rank the impact as a 4, meaning that the impact of the system to the organization is pretty high. So if we don't have a place to report our expenses, we're in trouble. And the likelihood that there are risks to the organization as a result of the project, I would again rank that as a 4, with a multiplier of a 1 to start out with, giving it a final score of a 16, or above the line. So remember that anything with a 12 was generally below the line, but anything with a 16 was considered above the line and part of the, probably going to make the audit plan. So I would input all this data into my annual risk assessment template for my notes immediately following all of my planning meetings for that particular day. Then when coming up with the agenda for the VP meeting, I would add the risk and the audit project to the list in the agenda for projects to discuss with the VP. Then once we got into that meeting with the VP, it would be addressed. So if the VP was okay with the project or thought it was important, then it would stay. If she didn't seem that interested in the project moving forward, I would just note this in my notes and probably go back and reevaluate the score and maybe downgrade it to a 12 or below the line. Then from there, the project would be discussed with my manager and ultimately at the company-wide risk assessment meeting with the entire audit department. And from here, it would probably stay below the line and possibly become an audit project depending on the fluidity of projects that made the plan. And that's pretty simple, and that's basically how audit projects makes its way through the process in any organization. So that was a lot of data that we went through today, and hopefully you gleaned something from all that we went through. I know it was a lot, but in conclusion here, the risk assessment, you're going to start out with your company's risk definitions and go from there. Or you can start out with, you know, the company's projects that you think should be done and go from there and add a risk to it. Either way works. Both ways work. Use your colleagues and management as sources for possible audit projects and be creative. It can be fun. That is, if you're in dire need of more projects, which I am thinking that most companies are not, but if you are, there are many ways to come up with projects. And follow the money the organization spends to come up with the list of potential projects. You know, wherever your organization is spending money, that's likely where you're going to want to be. And be sure to make sure you understand the inputs from the directors and ultimately the VPs of the areas you're assigned so that we can add value, basically, through our process. And always remember your audit plan is fluid. It's a fluid document, and things are always going to change. So be suspicious if they don't. And with that, I will be glad to take any questions that folks have at this point. And thank you for your attention.